For many, I'm sure they're aware of the power that these two companies have and the dominant force that they are. But spell it out for us, exactly your story perhaps tells Lyft the example best about just how much they depend and indeed are sort of controlled by these companies.
Right, so I mean, Lyft, for example, spent $90 million on Google Ads in a single year last year. Those people went to an Apple app store, downloaded the Lyft app when they opened it. Google Maps was powering the maps behind it, something else that Lyft had to pay Google for. All of this was hosted on Amazon servers using Amazon Web Services. Lyft has a $300 million contract with them through the next 3 years to pay for all that. And on top of it, Google owns 5% of Lyft and has a board seat itself. So, all it's obvious that Google, Amazon are very, deep within the digital economy. But when you look through these filings, you really see how concretely they are kind of, the infrastructure behind how many of these companies work.
And in some ways, this is a blessing. In some ways, it's a curse. I mean, Mark, you focus on both Amazon and Google. And from the blessing side of the equation, do you see it as a good element that these companies have, well, so much riding on, whether it be financially, but also from their future revenue stream from these recent IPOs?
I don't know, Caroline, there's good and bad to that. The benefits of cloud computing is that it allows startup companies that eventually want to go public or are going public, to avoid a lot of infrastructure costs. You can treat all of your IT needs as variable costs rather than big fixed costs. You don't need to buy and build up a very large IT department to scale up a business. That's been the magic behind AWS, Amazon's Web Services, also behind Microsoft Azure and Google Cloud. So in many ways, what they're offering is a real benefit to these companies. But there's no doubt that in order to scale up on the internet, you're probably going to need to pay one of those three cloud providers. And then if you're a consumer-oriented service and you need to get consumers to use your service, to use your app, to get to know you, you're probably going to be spending money with Google, Facebook, and probably just those two. Like, that's how you get brand awareness on the internet these days. So I don't know if they're toll keepers. That's probably too strong of a word. But they're clearly the biggest channels out there, and you are going to be dependent on them. Hopefully, companies that are really successful and that investors like to look at are companies like an Uber and a Lyft long-term that can create brands that are strong enough that they can avoid having to get traffic only through those paid channels.
Yeah. Garrett, your piece also shows how many of these IPOs, I think it's 17 out of the recent 22, right, that are in some way mentioning Google, Amazon in their statements. Is this something regulators are looking at? Are they actually worried that perhaps if they clamp down too hard or try and push for breakups and the like that Elizabeth Warren's talking about, this could actually impact those that sit downstream?
Right. Yeah, I mean, on the one hand, you could say, look how powerful these companies are. We surely need to break them up. On the other hand, you could say, well, they're not interested in necessarily disrupting these smaller companies because they're their customers. They want them to keep growing. Google wants Lyft to keep growing and still use Google Maps and pay more and more for it every year. So, you can kind of look at it from both directions. And as this argument goes forward, I'm sure you'll be seeing the arguments from both sides. But I just want to say, I don't necessarily think that by breaking up these companies, you would necessarily disrupt that web, in a really deep way. I mean, you could still buy Google Maps from, Google Maps Limited and buy Google Cloud Services from Google Cloud Services Limited. So, we'll see how it plays out, but I'm sure this will be a topic of conversation when it comes to antitrust. Before
we go into the antitrust equation for the behemoths, Mark, I want to talk about the fact that you cover Lyft, you cover Pinterest as well. When you saw that in their filings they do show this competitive exposure and general exposure in terms of supply side needs from Amazon and Google, did you see that as much of a risk factor? Does that worry you? Would you like them to invest in their own independent service, for example?
I think the answer to that question is no. I didn't see it as a risk factor. I hadn't really thought about the way you set up the question. So if they didn't lead, if they were going to have a cloud services provider, it was going to be one of three names. It was either going to be AWS, Azure, or Google Cloud. And chances are it was going to be AWS. That's usually the lead cloud provider. They have almost 50% market share. So if they didn't do that, then the P&L that they would have gone public with, that they'd be going public with, would look a lot different. And you'd have a lot more CapEx spending. So it probably would be, frankly, a less attractive business model. And you'd also raise the question of, why are you trying to vertically integrate and build out all that infrastructure and manage all those data centers and those server stacks and IT departments when there are three companies that are doing a phenomenal job of allowing you to outsource it? So I'll just twist that question back at you, Caroline. It's a great question. I hadn't thought about it before. But no, I don't see that as I don't see that as a competitive issue. I don't think that's a dependence risk. And there is the option, by the way, of switching. And we have seen companies. Snapchat went public and switched or started switching over, migrating over from Google to Amazon. So as long as you can migrate, I don't think there's risk.
And Mark, what about the risk from a competitive perspective, from the regulatory viewpoint that we're starting to see coming from Capitol Hill upon Amazon, upon Google? Do you think that there is a risk that they are seemingly so intertwined with the rest of the tech ecosystem?
Possibly. I just look on regulatory risk. It's something that's clearly become a major investor issue across technology. We actually just hosted a call earlier today with an antitrust expert to talk about the risk that these large platforms face, particularly Google, but also Apple, Amazon, and Facebook. I think the chances of these companies having to be forced to divest assets, I think that's actually extremely unlikely. I generally think that if you company says they hold assets for multiple years, I think government regulators would be very loath to try to unwind any of that. I think it'd also be very hard to do that. I think you're more looking at fines or changes modest at the margin, changes in business practices. I would make one quick comment. We just listened to a weekend of presidential Democratic debates, and big tech really didn't come up at all, except for the one time it did was in concerns over whether Amazon is paying its fair share of taxes. The issue of Google's strong market position or Facebook's or anybody else's actually didn't come up, and that's probably the best political barometer. If it doesn't come up in a presidential debate, it means it probably doesn't matter.